Let me ask. So how do you take into account Meta essentially building out, the New York Yankees of AI experts with their super intelligence team? Like, how does that factor in here? Because that PhD to price ratio probably goes up. Guest today, Kai Wu, the founder and CIO of Sparkline Capital, a firm at the frontier of kind of quantitative investing, applying machine learning to capture alpha, from what he considers the intangible economy. There's more to talk about there. Kai, welcome to the show today.
Thanks for having me on. Great to be here.
Was super happy to have you on here. We've been going back and forth of getting you on here. I think, what I wanted to do was really start with the origin story of Sparkline and, just tell us like the beginning of, what, provoked you to, start a firm, and we can go into all the details, in the rest of the show.
Yeah, and I know this is a tech podcast, but I guess my origins are more on the kind of traditional value side. So I actually, studied economics in college and did my thesis on financial crises and bubbles. And that kind of led me to my first job, which was at a company called GMO based in Boston, which is, well known. Jeremy Grantham, the founder, for kind of being, very focused on applying value principles and doing so quantitatively, right? So GMO was one of the pioneers actually in using computers in the 80s and 90s to systematize the principles of Ben Graham and, security analysis, this idea that you want to buy stocks below intrinsic value. And so that, is price to book, price to earnings, these kind of methods that have over time become more and more kind of encapsulated by factor investing and various indices like that. But again, GMO was a pioneer in doing so, back in the early 80s. So that was where I kind of got my start. I spent several years at GMO and then, ultimately left to spin on a hedge fund with, another partner there. Again, quantitatively applied, called Kaleidoscope Capital, based in Boston. And then, went out solo in 2018 to kind of build out Sparkline Capital. And this is kind of over this period, sort of the, where this kind of converges, the thread converges with, Sean, some of the stuff you're talking about innovation and kind of where's the world headed, right? Because it's no secret that, traditional value approaches that primarily focus on, say, the tangible economy, that invest in banks and industrials and energy names, have not done so well over the past, 1 to 2 decades. And, a lot of and it's pretty obvious why, right? I mean, I don't think you need to be a genius to recognize that the world has changed and what drives value today is not so much tangible capital, but intangible capital. And so that was kind of my quest for setting out to build Sparkline, the firm I run today, which is how can we kind of marry the traditional time, tested value principles with this notion that the economy has changed and, the drivers of value are different. How can we quantify these things systematically, using machine learning and other kind of AI style models?
Yeah, and you had an interesting, piece that you wrote recently on Buffett. Obviously, Buffett retired this year, and he's stepping away. And you kind of had the history of Buffett's investments. I thought it was pretty unique, from Geico, to Coca-Cola to Apple. Just talk about what you're seeing in there, and kind of like why does it matter to Sparkline from a philosophical perspective?
Yeah, look, I mean, obviously, like any value guy, I mean, Warren Buffett's kind of a god, right? Like, so we spend, our time, kind of studying his investments, his philosophy, and Buffett's unique because for 2 things. So first of all, he's very transparent. He writes his annual letter. He hosts his, annual, meeting over in Omaha, and so he's very like open about his process. I think that's very valuable. And second, he's just been in the game for a long time, right? He's in his 90s. He's been investing for 60 years, at the helm of Berkshire, and obviously before that as well. And what's so interesting about, Buffett is the extent to which his investment process has evolved. Right? People think of him as, this Midwestern kind of charming, folksy guy whose mentor was Ben Graham, the original, inventor of value investing back in the 1930s. And that is true. But if you think about where he's come since then, right, I kind of talked about these 3 phases of Buffett's career. Geico being kind of the symbolic investment of his first, and Berkshire, of course, as well, struggling textile mill, insurance company, very kind of industrial, tangible capital focused. Second phase, Coca-Cola was, of course, his iconic investment. Talks a lot about See's Candy, where intangible assets like consumer brands became sort of the mainstay of his investment process. And then you fast forward to 2016 when he purchased Apple, and that single investment made $120 billion for Berkshire. So kind of carried his returns the past decade. And so you kind of have these 3 phases where it's like, he started off kind of as a, strict adherent to the Ben Graham philosophy, price to book, buy stocks below intrinsic value, defined as, net liquidation value. Then phase 2, let's add some intangible assets to the moat, so to speak, to the castle. And that includes, brand and human capital. And then finally technology, adding intellectual property and network effects, right, which are kind of the key assets for a company like Apple, to the mix. And so it's just really interesting to me to see how, Buffett had, as starting off kind of as, perhaps the iconic, proponent and disciple of Ben Graham, over time had, evolved this process to an extent to which, it would be totally unrecognizable to Graham, right? One of the things I talk about in my paper is how 92% of Buffett's investments, of his largest investments, were actually obtained at price to book ratios above one. So in other words, he was not a deep value investor like many think of him as. In fact, he was buying companies that were on average more expensive than the average S&P 500 company, but they happened to have these intangible assets that he believed, and it was largely correct, on average, able to kind of lead to further growth in earnings and kind of create these moats around these businesses.
Yeah, I've always said, when you look back actually at, some of Buffett's biggest, call it wins, specifically Geico, this was a growth company. At the end of the day, when you look backwards, here's a company that compounded its growth rate, its earnings power for decades, and that also, obviously led to, a re-rating, consistently over time for that asset, and then allowed them to obviously take, some of the float of that business and then reinvest that and compound over time. When you go to Apple today, or 10 years ago roughly, when they made that investment, what's also interesting as well is the fact that you know Apple, obviously, prior to that, had been around since the 80s, really. And he made the most amount of dollar, nominal returns he's ever made. And he said that recently at his annual meeting. And, but I think it's a good, reflection of, you don't have to be as early as you think to make, some of these really, really good investments. And it sounds like, from your firm, part of what you guys are doing from a quantitative side, and we'll get into the nuts and bolts of, how you guys do it, the early days of Sparkline to, to today, just in general, like, how do you take that, that history lesson, I guess, that we're seeing, in life today of Warren Buffett, and how he's built his business based on the back of Geico and then Apple, many years down the origin story of Apple itself.
Yeah, so I think, go back to what I was saying around the three phases, and how I mentioned this kind of addition of various intangible moats to Buffett's metaphorical castle. Right, you start off with looking for a margin of safety with respect to tangible capital. Can I buy this dollar at 50 cents? And then you say, well, maybe it's not just the cash on the balance sheet and the physical assets, which could theoretically be sold off, that matter. Maybe it's also just the brand equity. Right, how much is Coca-Cola's brand worth? Right, I mean, Coke spent over $100 billion in advertising over the course of its since inception. That's got to be worth something, right? It's $0 on the balance sheet from an accounting standpoint. We all know that it's worth something. And then you go to the next piece, which is human capital, right? Like, how much do firms? I mean, you have Meta CEO Zuckerberg going out and giving NFL level contracts, right, $1 billion contracts to AI researchers, right? Obviously, human capital is a huge component of the value of companies today. And then you go to the third category, intellectual property, patents, know-how, source code, all the sort of stuff that drives mainly technology companies, but also basically any company today. How innovative is this firm measured in various ways? And then finally, network effects, which I think have become more, they've existed since, the days of, markets and, the Silk Road and markets in, through the Orient. But up until today, with the internet and the explosion of the world's population to be, 6 billion plus, and then you have like everyone connected now on the internet, the size, the potential size of a network is a function of course, the number of nodes in that network, and that's only increased through time. So you have, just go back to Facebook, they connect billions of people. The kind of potential value of that network is significantly higher than when it was only a handful of users in a few colleges. Right. And so that's becoming a very important component. Going back to Apple, that may be the most important component of Apple in a way, because their app store, right, which is their kind of is so powerful. They charge what, a 30% tax effectively on any transactions there, and you have all these developers who are not on balance sheet. They're not employees of Apple. They're sitting there building things, and you have people like myself downloading these apps and doing stuff on them, and Apple just sits there kind of taking their tax. And then you kind of step back even to the hardware ecosystem that Apple's built, right? I'm wearing AirPods right now. AirPods are awesome, and they interact really well with the iPhone, which I'm using as a camera right now. And so these things all kind of fit together in this ecosystem. And so just the value of that, as Apple kind of brings in more and more devices to this kind of innovation platform, increases the value inherent in that ecosystem.
Yeah, no. So I see the network effects slightly. I've always believed, I guess Apple's, biggest advantage is the switching cost. The idea that, you do have the AirPods, you do have the iPhone, you may or may not have a MacBook, but you probably have an iPad and you maybe have the Apple TV. And then you have all the apps that are, existing in that ecosystem. I've time and time again, I've said, man, that's a really cool Samsung device. But it sits on Android and all the apps. And it's just the thought of like, trying to convert over, and you don't know what's going to happen when you convert in business and personal and, text messages and group chats and what's going to happen. For me, that's like the biggest, moat I think Apple has today, which is probably, obviously we're talking about the world of AI. They have time to figure it out. The question is how long, and what is going to be their approach to AI, and that's a whole nother conversation. I don't even know why I'm bringing it up, but but that's like my view, or even our view, here at Avery, the view of like the moat Apple has. But look, here's a multi-trillion-dollar company. They clearly have a lot of moats, all across the board, from developers, to the users themselves. Anyways, but like the to dig into your strategy, let's start at the early days. Like, what were you trying to build, at
Mm.
Sparkline, and kind of like the aha moment where you're like, let's go after this, let's build it, and then how are you building it?
Yeah. So the kind of original goal, I guess there were kind of two threads. So the first one was going back to what I mentioned around GMO, right? So my entire career has been spent as a value investor trying to understand how can we modernize a lot of the techniques that obviously have struggled the past decade or so. And that's kind of when I stumbled upon this idea of intangible assets, right? Just look, there are several important influences. There's a book called Capitalism Without Capital, which I would recommend. Another one called The End of Accounting. I'd say those two books were pretty formative. There are others as well. And just kind of just like, thinking through like what have been the major changes to the economy that could potentially change the drivers of corporate value today. So that was kind of the first thing, which is, identifying intangible assets as being kind of a key missing ingredient in most systematic value investors' perception of intrinsic value. And then saying, how can I go about quantifying it? And then so the second thread kind of in parallel was this recognition that and appreciation that machine learning and eventually deep learning and eventually large language models would be basically become a game changer in the investment industry. And I actually wrote a paper. So I think the first thing I wrote was in 2019 when I recognized I wrote this paper called Investment Management in the Machine Learning Age. And one of the key insights was that unstructured data would be I believe would be a really important source of information for investors. Right. So unstructured data is just text, emails, websites, audio, video, like this podcast, information that's not sitting in an Excel spreadsheet or a SQL relational database. And quantitative investors have primarily focused on the structured data for obvious reasons. It's way easier to manage and to process, and it can be used. You can use linear regressions on them to kind of structure it, etc. But what I recognized was that that data was less than 20% of information outstanding, and for many reasons had basically declined in value over time, right? Because think about like accounting information, book value, reported earnings, right? This sort of information does not capture intangible value, right? Both through inconsistencies in the way that U.S. GAAP accounting works, as well as just the fact that there's network effects are off balance sheet assets, right? When a company reports its headcount, it doesn't distinguish in the quality of its headcount. And so I pretty quickly recognized that accounting information was not really going to be sufficient to capture intangible assets. And then that led me to the unstructured data, saying that there's this massive amount of information. We live in this digital age, exponential increase in information, but it's primarily unstructured. How can we go about doing that? That obviously contains valuable insights with regards to intangibles like patents, trademarks, LinkedIn profiles, etc. So that was kind of the first recognition in 2019. In 2020, that was when I wrote a paper called Deep Learning in Investment Management. And the insight there was, a lot of quants at the time were attempting to use like deep neural networks to directly predict stock prices. And for a variety of reasons which we can get into, I felt that was a dead end. But instead, I said, why don't we use these tools as a way of upgrading our kind of understanding of natural language, right? To use it to take unstructured data and process it. And that ended up being, evolving into the large language model and then ChatGPT, and then, where we are today, where the models are just so much better than they were in 2020. I went from, creating my own models, open source models, to now using, a lot of the options provided by some of the world's largest providers, like, the OpenAIs and Anthropics of the world, which are, way more intelligent, of course, than anything that, a small boutique firm like myself could build. And so I think I was largely correct then in kind of saying, look, these AI tools are their killer app is the ability to take unstructured data, process it, make it structured. And then the idea became, can we find a variety of sources of structured data that may contain information on intangible assets, use large language models and other NLP techniques to distill that information into structured scores, and then use that alongside traditional quantitative factors in building a composite that better represents a kind of more holistic conception of intrinsic value that includes not just tangible but intangible capital.
Got it. So you debunked, the theory. Let's get into that.
Let me explain that better since I kind of glossed over that. So, rewind the clock to 2020 and even before that, right? This was, machine learning, kind of boosting techniques. These things were obviously being more widely applied throughout quant shops. Deep learning, which has of course existed for many, many years, if not decades, but was becoming more popular due to the advances in computing, was also kind of on the rise. And there are kind of two ways you can use this in a quantitative process. If you step back, there's really two steps in a quant process that this could even be useful in. So the first step is what we would call like signal generation. It's like taking information in the world and creating structured factors out of it. And the second step is to take, say 100, 1,000, a million factors, and then allocate capital across them, right? So if I said, hey, here are 100 different features that could potentially explain a stock price, then you say, all right, well, which of these things matter and what weights? Is it a positive or negative coefficient? Is it other interactions across the terms? Right? Historically, that's been done with linear regression or even just kind of more basically just through intuition. By saying, hey, I believe from first principles that this should be a positive one, this should be a negative one, so on and so forth. Well, there's a branch of inquiry into the question of, hey, can we apply these really sophisticated, complex models into this kind of alpha selection or capital allocation step of the process? And this would, of course, converge with a completely kind of computer-driven model where you're using data you're fitting historical data to kind of build a model to explain stock returns. And my thought at the time was putting aside high frequency trading, where you do have a lot of data. The problem with financial data is a few things. So first of all, as quants, we love to say like we have the biggest data sets, but in reality, we don't. If you think about like the average investment horizon as being say a year, right? If you're a medium to long-term investor, like a value investor, you say, I want to buy the stock today. You're not really going to know whether or not that worked out for at least a year. And then you say, well, maybe there's 3,000 liquid stocks and we have like 40 years of data. Well, those numbers, like when multiplied, give you 100,000 or so observations, which is a fraction, of course, of the number of websites or tokens and used to trade. Say Llama with like 3 trillion tokens, right? So this is like basically it's like a joke. Second, the data is very noisy, right? If you have a hit rate of 51% as a stock investor, you're doing pretty good. Whereas like for most kind of traditional computer vision or NLP based tasks, you want 95%. Otherwise, you're not doing so good, right? So noisy data, small data, and here's the kind of killer is non-stationarity, right? So if we think about natural language does evolve through time, right? New like technical terms, new slang enters the lexicon gradually over time, but that's a pretty slow process. Whereas like if you think about markets, they're always evolving, right? The factors that worked really well 10 years ago maybe don't work well together anymore. People discover the anomalies and they arbitrage them away. And so just kind of the dynamism of markets and non-stationary markets makes it really difficult to use historical data to then say, oh, well, historically these factors, like when, CEOs say X, tend to be correlated with returns going forward. Well, the problem is that like, CEOs are coached. And then the next year they say, oh, well, I discovered that that saying this, made the machine short my stock. So I stopped saying those words. And to the point just being that I kind of felt that was a dead end. And then conversely, the other where I thought that the value was more, encouraging was more in the unstructured data side, right? There, as I mentioned, there's, zettabytes of unstructured data out there. Most people don't really look at it, or most quants don't look at it, because it's just so hard to deal with, especially this is, 5 years ago. In theory, you could go out and hire, a team of analysts, say in the Philippines, they're going to go read through 1 million patents and then, score them and structure each thing. How innovative are patents, from different companies, and then kind of roll it up to the company level. But that's obviously a very subjective, manual, and time-intensive process. And so what's been so exciting is the advent of various NLP tools, starting with simple word counts. Oh, how many times does this patent mention AI? Okay, that's very basic. And then embeddings, and then finally full-fledged large language models, which now allow us to automate the process I just described without having to rely on thousands or hundreds of analysts to make subjective judgments as to the value of various patents.
So I have a view that analysts are going to become very, very lazy. And, that's part of there's an arbitrage opportunity there where, people are going to go into these models today. It's capturing structured and unstructured data. The output is, fairly reliable in terms of, generally question in, answer out. And analysts will become very lazy, highly dependent on the output of these models. Um, just because the speed to an answer that sounds good is very high. And, how do you kind of reverse engineer, some of these models where you're basically saying, the average person is going to go in there just like they filter on Yahoo Finance, and says, give me the top 10 industries. Okay, next level. Give me the 10 companies in each industry. Okay, next level. And then you're going to say, give me the where the valuation blah blah blah, is this or that. And a lot of people are conceptually going to get to the same place. That's my view. And the question is like, what are these models? Where's the gaps that aren't showing up? Kind of like what you were doing, which is unstructured was the gap, and structured was where we all could get an answer that surfaced. Like, what's your views on that, and kind of like the lazy analyst going forward?
Yeah, I think you probably saw like the headlines that came out, pretty recently around like the lawyer who like basically got sanctioned and disbarred by a judge for having ChatGPT write the brief and then didn't check over it, right?
Yeah,
Like,
I mean
and
that's the definition of highly
that's
dependence
laziness.
on a model.
But the thing is that like the thing is that like you have to remember like in a traditional law firm you'd have paralegals and kind of junior associates who would be doing a lot of the drafting, and like what is the partner not going to look over the work? They should, and they have to. And I
Right,
think the same thing is in our industry, right? Where it's like you wouldn't like just hire a bunch of interns to pick some stocks and then just like without even looking at it like go buy those stocks, right? The portfolio
sure,
manager's job is to take that input and kind of assess it. Does this make sense? And like filter it and eventually come up with an opinion while leveraging, using the leverage of the junior folks to kind of for data gathering and potentially some, more basic analysis. So I actually wrote a paper called AI Financial Analysts. I think it came out last year. And, in it, I had this like analogy, right? And again, this is an analogy. It's not a perfect description of the world. But I basically said, look, we can broadly divide the investment functions of an investment firm into two categories. You have your analysts and you have your portfolio managers. And analysts, their job was to stay on top of the news, like as if you have a few companies you're following, you want to know like, hey, our CEO is leaving. Like that's a bad thing. What's insider buying or selling? What is what is the management saying on the latest earnings call? What is the sell side saying about said company? Basically, gathering all this information, synthesizing it into kind of a basic model. And then you have your portfolio managers whose job is twofold. One is to guide research to basically say, hey, analyst X, you need to be looking more in the sector. There's potentially opportunities in a special situation, Y. Or to take, and second, to kind of curate the information that's being fed to them by the analysts, saying, all right, I have these 5 analysts, they're giving me all this information. Let me try to kind of bring it together and then determine the capital allocation, right? The step that I thought the machines couldn't do because of the small data problem. And that requires creativity, requires reasoning skills that, I was able to show in this paper. At this point it was GPT-4, so maybe it's a little better now, but was insufficient to be able to survive to do that second thing. So basically, my point was, look, AI, like quant in general, is really, really good at taking large amounts of data and processing it very quickly. Right? The use case I described of saying, let's take 1 million patents and process each one by one. What it's not so good at is reasoning. It's not so good at saying, all right, well, now I have all this information. What do I do with it? And that's where I think, at least currently, humans still have the edge. Right. So, my idea of this hybrid investment, firm would be one in which, a lot of the kind of junior analyst roles were starting to be outsourced to AIs and AI like tools, whereas the senior portfolio managers, if anything, just got more leverage. And I think you're seeing the same thing happening in newsrooms and in journalists and media, in law, as we described, and a lot of other professional services, where like a lot of the kind of more basic analyst level tasks are now kind of being or losing their comparative advantage against AI, or the more senior kind of experience, wisdom, judgment, dependent tasks are still, at least currently today, humans still have an edge there. So I think the success, for any organization in the knowledge economy, largely depends on trying to navigate this thing here, taking advantage of the benefits of AI without kind of giving over key functions that, say through hallucination or other kind of problems, could lead to significant issues on kind of these mission critical decisions.
for sure. No, no, I totally understand that the lines between the computer and the human will continue to converge, and the best firms will kind of have guardrails at each step of the way. I guess they call it like human in the loop for some of these AI agents that everyone keeps talking about, and that makes a lot of conceptual sense. And there will be some things, it could be the earnings review that becomes synthesized by an AI, and that becomes something that is predominantly highly dependent on a computer versus a human. find me, the scoring sentiment score of this. You used to have to, go on there, listen, and try to judge the health and, the happiness, I guess, let's say, and or, the stress levels of management as they talk through certain issues. So a lot of that can help and ease, some of those tasks. Now, let's get down to, the actual strategy itself at Sparkline. So you have, I believe, two ETFs, two active ETFs, and both are along the lines of intangible assets and using your, computing and computer science, kind of capabilities to synthesize and figure out, where you guys need to be. Just talk about, let's ITAN specifically. I'm looking at your holding list. And again, for listeners here, this isn't, a recommendation for anything, including his ETF or, anything, companies that we mention here. So for informational purposes only, but you have, Amazon, and then you have IBM, which, for me, I hear Amazon, pioneering obviously e-commerce and cloud. And then you have IBM, which obviously, if you think of, we were talking offline about our strategy and, not to go into that, this is about you, but it's, that's like a legacy incumbent player that is kind of having its second wind. We just saw that with Oracle as well. Oh, you have it in the portfolio as well. And so just talk about ITAN, your portfolio, how it gets constructed. I can see that Amazon's, 5% versus IBM's the second, largest holding at 2. So just trying to understand, how this whole thing gets put together.
Yeah, well, the goal here was to build a fully systematic process. This does not require, overrides or human judgment on kind of any single name. And so you think about, what does a traditional value, kind of systematic value fund do? Right? They say, all right, well, let's look at all the stocks available in the investment universe. In this case, U.S. top 1,000 stocks. And then we say, all right, well, let's take a metric on which we care and then build a portfolio of the stocks that are highest on that metric. Right? So typically, in a traditional value approach, it would be like price to book ratio, which I mentioned, price to earnings, EBITDA, price to free cash flow. These sorts of, the denominator is going to be some measure of value, however defined. You could even use a more complex dividend discount model for that. And then the price is always a numerator. And you're always looking for the cheapest stocks relative to what is it that you care about, this intrinsic value concept. And so I mentioned to you, like, the idea of taking unstructured data, using a combination of machine learning, large language models, and traditional approaches to create factors for each stock. So, for example, like, how many innovative patents does, I guess, Amazon or IBM have? What about trademarks? How many PhDs do they have? You take these various metrics and you scale by price, because ultimately, as a value investor, you're not just going to buy the company with the most IP. Then you're just going to buy large cap stocks, right? You're buying companies with the most IP per dollar invested, the most human capital per dollar invested. So it ends up being a value strategy. And so stocks can kind of end up in the portfolio for one of two reasons. Either they're reasonably priced, but they're just like super high on intangible intensity. Or, as more in the case of IBM, they tend to be, just really well priced, or at least when we bought it, whenever that was, well priced relative to okay intangible value. Right. So everything's always considered on a relative basis, because, of course, like, you can only assess a company's worth in relation to how much you're paying to obtain that value.
Yeah, no, I see it. R&D, sales and marketing, patents, PhD, all those relative to price, which gives you, some sort of interesting look into, what and then also the actual, call it competitive moats or, advantages that you think intellectual property versus, let's say, the market. It's a pretty cool way of looking at, things. Let me ask, so how do you take into account Meta essentially building out, the New York Yankees of AI experts with their super intelligence team? Like, how does that factor in here? Because, that PhD to price ratio probably goes up. Patents probably stays the same for now. Sales and marketing, I don't know where you go with that. R&D, this is kind of all R&D, intellectual human capital. So how does that all kind of like manifest into I'm sure the last month, 2 months, as you're reviewing this, you're kind of thinking through, how do we incorporate these kind of factors into our model? Because it's probably going to continue to happen here, at least for the foreseeable future between, now and year end or end of 2026. So how does that factor in?
Yeah, it's funny. I mean, I think this meta thing is kind of like it's almost like a even more extreme manifestation of this kind of war for talent that's been, kind of brewing for many, many years, right? If you rewind the clock back to like the '07 period, right? It was like, Goldman Sachs, McKinsey were competing for like the best MBAs or whatever, right? And then, you go forward 10 years from then, and it was like everyone like is trying to be Google to hire all the best, software engineers, like traditional software engineers. And now it's AI engineers, right? So, this is just even more extreme. Like, think about a pyramid, extreme, like top 0.001% of talent. But the kind of underlying dynamics are still the same, which is all companies want to have the most talent and they want to steal them or prevent their competitors from taking said talent. So one of the things I actually did was, when I first did this research in human capital years ago, you can start off by looking at like LinkedIn and job postings and other sorts of data like that to determine which companies have highly qualified personnel, PhDs being just a proxy, of course, right? For that. And you say, well, maybe I can do better. I can say, well, this guy has a PhD from like MIT. That's pretty impressive. Let's give him some more credit for that. But that's still obviously like, very much like a proxy for true talent. Just because you went to a good university doesn't mean you're, the be all and end all. So one of the things I thought was really interesting was, pedigree. This idea that, like, for example, it was the this so some of the $1 billion AI analysts, right? That Meta is trying to get. He's getting a lot of them
Sure.
from OpenAI, and why OpenAI? Well, they're kind of the best, or among the best. I'd say Google's up there too in terms of like AI talent. And so a lot of it comes down to not so where did you go to school or where did you train, but like where did you work beforehand? Because you're bringing institutional knowledge. I mean, these are the guys who trained GPT, 4.5, O3, etc. So they have some like kind of inner insights that like you would only obtain being within the walls of OpenAI. And so what I actually did was, in the research was said, let's trace the flow of human capital from company to company. And, if you are able to obtain talent from kind of the most prestigious, most powerful, best firms, that's probably a good sign. And if you're losing talent, conversely, to your worst competitors, that's also very concerning. And the way you solve for this just mathematically is actually PageRank. So the same algorithm that Google used originally to build Google Search, which is kind of a way of obtaining a kind of closed form solution to this like a network graph problem where it's kind of circular, right? You want to know, company X is, Meta is being able to obtain talent from OpenAI, but OpenAI got talent from Meta, right? So it's kind of circular, but you can kind of solve it with PageRank. And so that's kind of the idea, which is like you're looking for companies that have good talent today, and by the way, are kind of from a flow basis obtaining talent from the OpenAIs of the world. And then to your question, right, Sean, you were saying, well, how do you look at that on a value standpoint? Well, look, at some price, as I mentioned, these guys aren't worth it. Like if I told you, hey man, I'm going to bring this AI guy in, and I'm going to pay him $1 trillion, like, my entire market cap for that. You're like, all right, that's probably not the best idea, right? So at some price, so you have to kind of debit that, of course, from like their enterprise value, because everything is a value equation. And I think in the case of the Meta acquisitions, what makes it so challenging is it's, I think we can both broadly say that human capital tends to be, a missing intangible. That people have historically tended to undervalue intangible capital. That being said, I think that like in this case, like these are really big numbers, and it's getting to a point where like we've almost never seen this before in historical precedents. I don't think we've ever seen a $1.5 billion deal given to a single AI researcher. So I think it remains to be seen whether or not this pays off for Zuck and for his company, but. It's certainly an interesting development to watch.
Yeah, I mean, it's almost like you can build a, Yahoo, fantasy football league where you're tagging each employee at every company and then kind of like, I mean, it's possible, right? Like you said, anything is possible to some degree if you can find everyone, on LinkedIn or something like that and tag them and know, when someone's flowing to the other, because at that point you can get ahead of it. Because I'm looking at some of the data points, right? PhDs per price, patents per price, sales and marketing per price, R&D per price. If all this stuff's somewhat in motion, we would have to wait, a quarter or 2 quarters for that to flow into some of these metrics. And, can you get that ahead of time, which actually could just be a, pretty interesting, call it investment opportunity should, PhD to price actually have any sort of, forward indication of, value of this business, which conceptually it does, obviously.
Yeah. So
You
just on that real quick, that's a question I get a lot. And, so I did some interesting research on this where I asked the question, I said, obviously this only matters if it ultimately translates into earnings, right? Like just getting, talented people and,
Yeah.
creating really cool code for the sake of doing it. Like it's only helpful for the investors if they actually translates into earnings. And so I did this analysis. So I looked over over all the companies in my database over all time periods, right? So a panel analysis and said, okay, let's look for companies with really, really high intangible investment, companies that are doing what we just described. How does that translate into their changes in their return on equity or just their profit margins over the next N years? And what you find is 1 year future, one year forward is actually a negative cost. In other words, it's a J curve embedded in this. So in other words, if I'm spending money, say on R&D, trying to invent the next Ozempic or whatever, probably not going to pay off in 1 year. But years 2, 3, 4, you see this kind of incremental increase in ROE as a result of this investment, such that by 10 years forward, it's a pretty meaningful increase, right? So that's kind of the key insight here, which is these intangible assets are important. They're balance sheet assets, of course, but they do translate into the income statement in as much as over the course of, say, 5, 10 years, if you're a long-term investor, you get the benefit, because you build these moats. Now you have this patent on, Ozempic. Now you have this amazing brand you built through all these marketing efforts you've made, and you can kind of sell your Hermes bags at whatever price you want. That's really cool. And so, intangible investment is kind of like this delayed impact on future earnings, which I think is part of the reason why it tends to be undervalued, right? In all our studies, it's like, well, markets are pretty efficient today. They tend to value most things approximately correct. But this intangible capital investment appears to be one thing where they kind of systematically undervalue it. And I think this is one of the reasons, which is like not only are markets more efficient, but they're also more short term, right? People are more focused on quarterly earnings and less about like the long term profits of companies. There's more quants, more high frequency, et cetera, more pie chops. And I think that to the extent that there's kind of a time horizon mismatch, and many investors are focused more on the kind of short term, quarterly earnings and such. That these sorts of investments that pay off in 10 years but not one quarter tend to be undervalued.
Yeah, doesn't that suck, right? Both of us are running, longer term, philosophical strategies. And, we posted a chart the other day. Again, the average hold is, less than a year. It was 7 years, a couple decades ago. And, everything you alluded to, right? The high frequency stuff, the Robin Hoods, nothing's wrong with any of this. It's just the fact that it's, quasi gamified, at this stage, and, instant results, instant gratification is kind of what, parts of the markets have become have, morphed into. But I guess in general, though, you want these companies that are constantly building out, multiple J curves, along the way. You have, if you look at someone like Meta, right, you have, Facebook Reality Labs and that whole thing going on. At some point, we saw Meta Ray-Bans, starting to kick in gear, and that's kind of like a decade-long, endeavor by them, and they're constantly trying to, iterate and shrink size of products, and then improve the actual software stack that sits on top of that. They sit in kind of this gaming, cohort that is, the most prolific users, I guess, of, some of this tech today. Eventually, we'll see what happens with the metaverse and all these other things. But, that makes a lot of sense in terms of people are too short term to want to wait around for, these PhD slash, brand equity, human capital, investments to pay off over time. Now, going from intangible to somewhat tangible, we just got, over the course of the last, this podcast will be around for a while. So let's just say over the past year, we've seen a lot of investment in AI infrastructure, where a lot of these intangible led kind of companies, Amazon, Google, Microsoft, Apple, to some degree, let's see there, have historically been, quasi asset light. Amazon, not so much in kind of actually in both their businesses, really. But then, you have someone like Meta, you have someone like Google, predominantly asset light business models, Microsoft as well. Combined spending, roughly like 300, 400 billion, in CapEx for, some of these data center build outs. You're migrating from kind of people will say, this is the next industrial age, right? To some degree. And, it's showing up in that in terms of the actual physical dollars for physical objects, like a data center that requires, this huge build out. Like, what's your thoughts on that as we kind of, the top of the market got there because they were asset light, because they were software led, user experience led, and now they're kind of going the other way, where now they're the utility, that they're the infrastructure from the ground up, and everyone's kind of living on top of them. It's interesting to think about what all this spend will look like in 10 years, but it's there's a reason why these mag 7s sit at the top, and the valuations are seem elevated to the average person, but when you put them in context of what we used to pay for energy companies, what we used to pay for utility companies and consumer staples like a Coca-Cola, they're getting those multiples because this is ultimately the foundational layer of arguably what's going to happen in the future for all of us. So, like, what's your thoughts on the tangible evolution that's taking place at the top of the market versus intangible, which kind of got them here?
Yeah, no, I have a lot of thoughts on that. I think one thing I'll talk about before, and you'll see how it connects, is a lot
Sure.
of the work I've done, because of my quantitative roots, or my college thesis was on the history of credit cycles and bubbles and asset prices and leverage cycles for hundreds of years, right? It's kind of this historical lens, and so it's really interesting to put AI in the context of the past technological revolutions, right? The railroad, the automobile, electricity, the internet, right? Mobile, I guess you could say. What we're doing today with AI. I saw a really interesting article. I think it was from the Wall Street Journal. where he linked to another thing where they basically looked at the amount of capex that was being funneled from the Mag 7 companies into AI servers, and looking at that in historical context relative to, say, the internet build out in the late 90s and the railroads. And I think the data showed that, the current build out is projected right over the next few years is kind of similar in magnitude, or similar as a percentage of GDP. So it's similar relative to the size of our relative economies to where we peaked in the internet boom, and a little bit less than railroads, but there's reasons for that. Railroads are kind of longer lived assets. We still going to use many of the same tracks that were built, many decades ago. Whereas, of course, like these NVIDIA chips, they last for like 3 years, right? And then they get replaced, so they become obsolete. And so that's that I think puts into context, historical context, of what's happening right now. This is a pretty tremendous, similar to what we're discussing with these meta hires. Like this is like an unprecedented, at least for us, build out of physical infrastructure. Last time we saw something so big was the fiber build out in the .com boom, and we all know how that ended, right? Where obviously fiber was overbuilt, and many of the companies that traded at super high multiples that actually built these things out were horrible investments for their investors, right? And it was kind of weird because you have this paradox where like as a from a societal standpoint, from a user standpoint, yeah, the internet revolution was a game changer. Like it completely changed the way we as humans live, and the economy totally was reoriented around this new technology. But investors in a specific infrastructure build out did not do well, right? And a lot of that's a function of like the entry multiples that people were really hyped up about the kind of infrastructure companies, and that didn't work out well for them. But you see, fast forward to today, and I think that the same risks are starting to emerge, where you may end up in a situation. I'm not saying you will. I'm saying you may, where a lot of the kind of more infrastructure focused companies, as they translate from asset light to asset heavy businesses, could end up in that same category. Now, the good news is that there are many ways of playing AI, right? You don't have to just buy NVIDIA. You don't have to just buy the Mag 7. There are many we were discussing this offline, right? Companies that are kind of in your kind of old economy legacy sectors that are just early adopters of technology. They're like, look, like we're in this industrial business, and we have these 10 competitors, and we're all a little bit behind the curve, but like we're gonna really kind of invest in hiring some talent and building out embracing this technology and using it in a way that we're not going to invent the next large language model. But what we will do is we'll like leverage the technology to be able to get a incremental advantage against our competitors. And by the way, our stock's trading at the same multiples as theirs, so like that would translate into significant upside if that were successful. Right. I think those sorts of names, right? You go back to the .com boom, right? A lot of the best stocks, best investments, I mean, were guys not necessarily were building the internet, but were kind of being the first to use the internet. I guess Amazon would be an example, right? To compete against legacy bookstores or whatever, right? So I think that's an interesting category. Not to get too much into specific investments, but like, yeah, we've been rotating out of Mag 7. Like at one point, like NVIDIA was a large holding, as were many of the Mag 7, because it was like, yeah, these guys are super innovative. They're inventing the next set of models and technologies that will power the AI revolution. But like at some point they get expensive, and then the question becomes, all right, like maybe as their business models translate into more asset heavy, they're less intangible. The kind of intangible advantage that we were discussing, right? Like these things tend to be undervalued, starts to go away. And then the question becomes like, what are the kind of more under the radar plays? And so there's kind of this natural rotation, as you kind of cross the chasm, you go to the next phase of the, S curve, right? The build out, who are the early adopters? How can we find them? And how are they priced? They're still pretty, on a relative basis, more attractive than many of the innovators, the first kind of tip of the spear that everyone at this point knows are innovative companies.
Yeah, I mean, look, Cisco just finally got back to its 1999 highs. They were so important to the the build out back in the day, when you and I were young boys. But so that's like one good example of like how a really good company can be priced way too aggressively too early on in its journey, and actually investors that had a thesis there were actually right in terms of the narrative and kind of their idea of like what is happening in the future. It's just valuation was the biggest concern. Even Microsoft, it took them 14 to like 16 years to get back to those highs they saw in, the early 2000s. Now you fast forward again to today, I made a post about EBITDA, right? Everyone's saying, okay, well, and they're trying to rationalize their valuation methodology on some of these companies that are building out massive data centers and infrastructure associated with it. And they're taking EBITDA, which I tend to use EBITDA either in the private markets where someone can actually come in, replace the I, do something with the D, and there's actual what's this core business producing, and can I help it, right? Can I lower the debt because my balance sheet's better than their balance sheet? And that'll bring down the I. Otherwise, we're talking about multi-trillion-dollar companies. No one's acquiring them, and therefore the I, the interest payments, if they do have debt, it should be accounted for. The D, depreciating a lot of these, assets, and amortizing them over time. I think all this stuff matters in terms of the actual cash flow these businesses generate. And conceptually, unless earning or revenue generation from a lot of this is much larger than you and I even can fathom, the free cash flow contraction in the future is likely going to be pretty big. We're talking 1-2x growth rates of capex budgets year over year, and that's all going to have to flow through. And then if you're concerned about the economy, that's a whole nother thing. But in general, like I think of this cycle versus all past cycles, and there's a lot of analogies that you can different time and place, but a lot of similar, I think, clear takeaways. Um, Sparkline. So like, stepping back a little bit, and not talking as much about, what's happening in the marketplace and markets. You guys are building, a business around kind of this in intellectual, intangible, asset, business using, AI today, but also, just historically, this is, what you've done in terms of modeling out where you want to be and how you want to invest. You've done so through an ETF format. Just talk about the day-to-day operation there at Sparkline. You wake up on a Monday morning, all the way to Friday. Like what are you guys doing there, given you are so quant heavy, it sounds like, and so people that are listening can understand like what happens in a quant shop like you guys.
Yeah, I think things have changed a lot over the course of my career. I would say that like if you go back, even to when I was at GMO, but even before that, like quant was like a very different game. It was as we discussed more asset heavy, right? There's a lot of investment that had to be done in building out your own physical servers, and asset management was generally kind of all done in a vertically integrated way. So you had to build out your own, trust, legal trust. You had to build out your own operations team to manage inflows and outflows of, into your mutual funds, let's say. You had to build your own compliance and legal teams. Like it was a pretty heavy build just to kind of get in the game. And I think that what's happened over time, like this has happened in general, right? This is kind of the idea of the billion-dollar unicorn. Is that a lot more has been able to be outsourced, right? So AWS was a game changer, of course. Like I even at my last fund before Sparkline, I actually built my own physical server room, which is like, why would I do that now? Right. Like I can use AWS, which is like way better and more efficient, and they have better security than I could potentially do myself, et cetera. Right. And you can do the same on ETFs as well. Like we use a white label provider who manages a lot of the trading and operations there. So you don't need, 100, mutual fund analysts, operations people to manage kind of the investor inflows, outflows. Right. So to the extent where you can kind of outsource more things, what that means is that what's left is kind of just your core value add. Like what's your core value add? Well, in my case, I think it's research. I think it's the build out of the intangible value framework and the acquisition of different data sets, and trying to test them and understand them, and then kind of incorporating them into the quant process. That's the kind of key component. That's what I centralize and kind of do myself. And then everything else, which is like that's not really my edge, right? You have to be honest. What's your edge in life? It's not necessarily like managing mutual fund inflows, outflows, or in this case ETF inflows, outflows. And so I kind of outsource those things. So I think things have really changed a lot over time, and you see more and more firms over time crop up that are more similar to Sparkline and what I do. And you also do see some of the more legacy firms over time, kind of modernize their stack, so to speak, and kind of embrace. You even see many large firms, when they launch ETFs or whatever, may do so through white labels as opposed to building out their own. And there's always kind of a build versus buy, in-source versus outsource decision to be made. But I think increasingly you're finding, folks more comfortable with this idea of, kind of a more lean model where they're just focusing on their core competency in a more narrow way, and then, outsourcing other things. And I think that's definitely enabled, in a way, kind of these boutique firms to be kind of able to get a lot done without having to necessarily staff up in a very kind of inefficient way.
Yeah. Like anyone listening that's actually, thinking about this path, like what's some advice, you've learned, I guess, from, the three different stints, a very large organization to a, starting your own organization, becoming pretty successful there. Sounds like, and then also, going, on your third path, you've learned a lot, right? It sounds like, during that, that journey. And, I would love to even hear, even from our side, like what's some advice, along that journey that you think could resonate for somebody tuning in.
Yeah, I think you have to be true to yourself. I think, there are a lot of people who are in the industry for the wrong reason. They may be attracted by the money, for example, or the fame. I think for me, I can tell you, I just love the research. I love figuring out these puzzles that is the financial markets. And,
For
you can
sure.
see this by the fact that I've, published over 2 dozen papers that like, I could just keep them private, but like I kind of enjoy it. And I enjoy publishing these things that, and that's how you found me, of course,
Getting feedback.
having,
Yeah.
yeah, having, getting feedback from the market, getting trolled, like that's just part of the game. Like, I want the constructive criticism, it leads to interesting conversations like these. And, ultimately, to the extent possible, that IP that I build kind of trickles into the products. Right. And so there's kind of this flywheel that's being built now where it's like I put out cool content, hopefully that's interesting, piques people's interests, that makes the funds better, so forth, so on and so forth. Right. And that's just the way I've chosen to do it. And there are, of course, many ways to build organizations. But I guess the key, just, my advice would be kind of figure out what your edge is, whether it's research or something else, and try to build your organization around that. And, to my last answer, to the extent there are kind of things that, just not your core competency, either hire somebody to do that for you or outsource it to somebody who can do it for you as well. And just kind of stay really focused on where you think you're top decile, top 1%, and just keep at it and be patient. Right. In this business, one of the other things is that like success is just there's so much randomness in markets. Like I think back to like the past, 4 or 5 funds I've launched over my career, like in every other one, just for some random reason, either starts out really hot or like gets unlucky. Like, you launch into a market that just isn't great for your style. Okay. And then things get better eventually. And so don't like, so like build with like an eye on like long-term like survivability. Like don't staff up like a huge team. So I've seen so many people do this, right? They launch hedge funds, they build like $1 million team, bring in the top
Beautiful
guys. They
office.
say, yeah, they get the best office, they get the most expensive service providers, so they can go after, the kind of top institutions day one. And like, yeah, maybe they get some capital, but they get unlucky, let's call it, in year one, in year two. It's just, they're not making the returns and they just don't have the runway to survive. So I think the entire game ends up being like, think back to Warren Buffett. This is the best example, right? 99.9% of his wealth came like in the past couple of decades of his life, of his career. And so I think the same thing here is for investment firms. Like I can think of so many companies that like they spent the first 10 years kind of just building out their IP, building out their brand, building a track record that was very good. But for whatever reason, like they never really got the attention. And then suddenly they became an overnight success. But of course they weren't. Of course they had been spending years and years building out the positioning to be there. And so you just don't know what kind of like luck's going to come your way or whatever in markets. So I think just the key is being, have staying power, both financially, but also in terms of like your conviction with your idea. Like have an idea that you really believe in and like be willing to kind of stand by that through thick and thin for many, many years, even if you get unlucky the first couple. So it's both kind of mental, psychological, and financial conviction.
Love it. Love it. Last question here is what AI tools do you use that, it could be off the shelf stuff or like, purpose built stuff for the finance world. Anything that, resonates that you just constantly keep coming back to?
So I have a pretty strong bias against using kind of industry specific tools, right? Oh, here's a ChatGPT wrapper for like finance. I tend to be, a little bit skeptical of those sorts of things. I just want the kind of best raw power. So, for example, with AWS, I don't use any of their products. Like, they have these like relational databases and like things that are managed. I just use a kind of the bare metal, just like what is like kind of the basic EC2 thing, and then I build my own stuff on
Build
top,
on top of that.
max flexibility, etc. So I tend to be skeptical of those things. So I think the raw intelligence comes from 2 3 firms, right? It's OpenAI, Anthropic, and Gemini. So that's where you want to build off of. Now I have built a lot of in-house stuff, like my own kind of in-house RAG, which is like retrieval augmented generation tools to kind of take my own in-house data sets and kind of ingest them in a way that I can feed them appropriately to the model layer to then come up with answers. So there's that. And then like, when it comes to writing and, looking at emails and saying, hey, can you just like make this like email a little bit more like pleasant, right? Those sorts of
For
things
sure.
I just use the chat interfaces for. So it's kind of bifurcated. It's just the standard chat tools that everyone has. And then like I build my own in-house tooling for kind of the quant model component. But that again is to the extent possible, I try to use just the most basic, like elemental, like layer of like intelligence, and then kind of build my own scaffolding within this kind of research environment that I've been developing over the years.
Very cool, man. Look, we're gonna end there. Great conversation. I was so happy to bring you on here. For anyone listening, where's the best place to find you? I'll give you a couple seconds to share the different areas.
Yeah, I think you just go to my company website, sparklinecapital.com. I have all my research papers posted there, and you can sign up for my email list there, or you can find me online. I have a LinkedIn and a Twitter account. It's CKAIWU, and you can kind of message me on those platforms.
Cool. Yeah, we'll put that in the show link so everyone can connect. And look, again, Kai, I appreciate you coming on. Kai, a special name in my life, my little boy. So, wish you all the luck in the future at Sparkline, and we'll bring you back, as you continue to grow that business.
Likewise, awesome to be on.